But right now, Lyft, obviously, they drove deep into their public trading debut on Friday with stocks soaring over 20%. But the ride-hailing service may be running out of fuel as its stocks drop below their $72 IPO price. Yahoo Finance's Emily McCormick is here with the latest on Lyft, and it's not unheard of for a stock after its IPO to swing like this.
Yeah, definitely not, but we are pretty significantly below that IPO price of $72. So to just give a map of where this stock has gone in its short history as a public company, so we IPO'd at $72 per share, opened on the NASDAQ on Friday at $87.24, and then closed that session down to $78.29, and it's now trading below that $72 per share. At the lows of the session today, Lyft touched as low as $69.12. And that was about 15 minutes into the trading day. That's more than 20% below that intraday high from Friday. So we are seeing a pretty significant decline from, a pretty significant swing just in the past day or so of trading. But now that we have this excitement around the IPO wearing off, really all investors have to go on is the fundamentals and those long-term growth prospects. And both have a lot of questions attached to it. We think about that net loss of $911 million that Lyft posted in 2018. That's the largest of any company in the 12 months leading up to an IPO, according to S&P Global Markets. So we are seeing a lot of questions about profitability and also how it will be able to capture market share as we see Uber about to hit the public markets later this year as well. Back to you.
All right. Thanks, Emily. Is any of this news to anybody? I mean, it's so amazing when you see these kinds of sentiment and stock swings on two different days, right?
Yeah, I mean, to me, the sort of bigger issue, taking a big step back here, is the fact that there's so little juice in the IPO because so much of the action took place in the private market. I mean, let's remember, this last financing this company has as a private was a Series I. A Series I round by Fidelity at $600 million. I mean, essentially, it's sort of a public company, except it's just for rich people on Sand Hill Road and, investors here on Wall Street. And so, it used to be that stocks not only would run up a little bit in the first couple of days, and that's, speculation, but that there's real, growth aspects and attributes to the thing going forward. And, here I just feel like the game's already up. Well,
you bring up growth. Emily brought up the fundamentals then. The big issue that we were talking about, especially on Friday, was the $914 million loss. Right. But we had a guest on who pointed out, look, this is an incredibly well-managed company, and that the metric to look at is the percentage of loss compared to their revenue. That is, the percent shrinks. That tells you that they're on track. Do you buy that?
Andy brings up a great point, which is that the trend for IPOs recently has been for companies to go public later and in magnitudes larger scale than they used to in the past. I mean, I was looking at, just out of curiosity, the S1 for Amazon. Have you heard of it? Small little company. Mm-hmm. When they IPO'd in 1997, they had a net loss too. A lot of companies have a net loss when they go public because they seek to get the capital to get them in the green. $5.8 million loss for the whole year at that point.
And people were screaming about that.
People were screaming about it. But now you have a company that's lost almost $1 billion. But the timeline is still about the same. Interestingly, when you look at a company like Amazon back in 1997, their projection to get positive was about the same timeline that we're hearing from these large IPOs, not just from Lyft, but also from Pinterest. So it raises this question about whether or not the name of the game for IPOs has changed. I mean, it's not unusual to see large price differences, but you would kind of think for a company that IPOs later, that they'll be able to have less price swings because the business should be more mature at that point. But I think what we're seeing through these timelines, I mean, this is going to be a while before Lyft becomes profitable. So I think the name of the game is pretty much the same, but it's just scales of magnitude larger.
And to take an even sort of bigger step back than Andy took, you also have to wonder if the whole process is flawed. And if this goes back to the whole theme of inequality in the United States, when, first of all, only certain people can invest in it when it's a private company. Then, even when it comes public, only certain people get access to that IPO. If you bought on that first day, and if this is going to be the future trend of the stock, you haven't done so well.
I agree with you 100%. And that's why I think the SEC really needs to look into this. And I asked Jay Clayton about this at the SEC, and he said, well, we're looking at it. I mean, I think it really, speaks to this problem of inequality. And, are you a public company or a private company? I think they're sort of having it both ways in these extended, super attenuated private times.
And we talk about scale too. I mean, the real big beneficiaries of this trend for these IPOs to IPO later in scales of magnitude larger are the underwriters themselves. I mean, the amount of revenue that they take in from helping these companies go public are immensely larger than they used to be when companies were a lot smaller.
But also the VCs, they get all that gain from the Series A to the Series I. I mean, you wonder why, like, you're seeing venture capitalists becoming billionaires, VCs being billionaires. Now, I know there's a time value of money in billions of dollars, not what it used to be, but still, I mean, I think it's crazy that, again, to your point, Julie, all the money is going to a very select group of people, and I think that we really need to consider that.